Hi, welcome to this quick guide to the balance sheet. We're going to explain what the balance sheet is. Okay, introduction. The balance sheet. It's also known as the statement of financial position. And it's a financial statement that is like a photo. It's a specific date or a specific point in time, and it's like a photo of an organization's financial position. For example, you'd have a balance sheet for the 31st of December 2015, and then you would have a second balance sheet on the 31st of March 2016, so perhaps it's a quarter later. Within a balance sheet, it'll list assets and the asset accounts and their respective financial balances. Below the assets, there would be liability accounts and their respective balances. And at the bottom of the balance sheet, there would be equity accounts and their respective financial balances. So that's the introduction. Okay, so at the top of the balance sheet, we have assets. And there are a number of assets accounts. So you may be asking yourself, what is an asset? So the complicated accounting jargon definition is that an asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. And that's from the ISB conceptual framework. But that's kind of a complicated definition and a bit hard to get your head around. Here's the simplified definition. It's something that is controlled by the business that will make money for the business. Essentially, it's what the business owns or controls. For an asset to be recognized on the balance sheet, there's three criteria. Firstly, it must be something that's within the business's control. Generally, this is ownership, but it doesn't have to be ownership. For example, you could lease an asset and it will be on the balance sheet if it's a finance lease. The second criteria is it must be based on a past event. So it's only on the balance sheet as a result of a past transaction or past event. Nothing that occurs in the future can yet be on the balance sheet. And thirdly, it must generate a future economic benefit. In other words, it must make money for the entity. And the examples we have here is a truck or cash. So the business controls the truck, the business controls the cash. From a past event, the truck was purchased a year ago, the cash was banked from a customer a month ago, and it will generate a future economic benefit. So the truck will deliver goods that will be sold at a later time, or cash will earn interest. So it meets all the criteria to be recognized on the balance sheet as an asset. Okay, there is a bit of a distinction on the balance sheet between what's called current and non-current assets. So you'll often find the balance sheet has a current section and a non-current section. Now, current assets are those that will be realized, and realized is a term, and that just means they'll be turned into cash or used up, consumed within a year. So assets that will be realized within a year are termed current assets. And the examples we have here are cash, because cash is already itself cash, accounts receivable, so you collect payments from customers normally within a year, and prepayments. So if you prepay assets, you normally use them up within a year. And on the flip side, we have non-current assets. They're the other type of assets. And they're those that will be realized within a period longer than a year. That is, they'll be turned into cash or consumed or used up for a period longer than a year. And for instance, we have PPE, which is property, plant and equipment, and that normally lasts longer than a year. We talked about a truck earlier. Trucks normally last longer than a year and won't be completely used up within the current year. And IT equipment, even IT equipment lasts a few years and isn't going to be turned into cash or sold or become obsolete for a few years. Okay, so below the assets on the balance sheet is the liabilities section. And again, you may be asking, what's the liability? What am I looking at here in the balance sheet? Well, once again, we've got a complicated accounting jargon definition. Thank you, ISB conceptual framework. Okay, so a liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. Okay, that's pretty complicated. Here's the simplified definition. A liability is something that the business must do that will result in an outflow of funds. And essentially what this means, it's what the business owes. So assets were what the business owns, liabilities is what the business owes. And again, for a liability to be recognized on the balance sheet, there are 3 criteria. It must be a present obligation. So on the day of the balance sheet, there must be a current obligation, a present obligation, not a future obligation, not a past obligation. That obligation must be based on past events. So a transaction or event that has occurred previously. You can't book a liability, something that might happen in the future or is expected to happen in the future. And the third criteria, it must lead to an outflow of economic resources. And another word for economic resources is just cash or money. So it leads to an outflow of money. And the examples we have here are loans or accounts payable. So you owe a loan presently. It's an obligated to make interest payments and pay back the loan. It's based on a past event. You took out the loan a year ago and it leads to an outflow of resources. So you have to pay back the loan. Money leaves the entity. And once again, liabilities are broken into current and non-current liabilities. And these are similar to assets. Current liabilities must be settled or paid back within a year. And for example, accounts payable or salaries payable. And they're normally due, within a couple of weeks or a couple of months. Non-current liabilities need not be settled for at least a year. And the examples we have here are bonds or other long-term debt. Okay, so that's liabilities. The final section we have is equity. And again, what's equity? We have a ISB conceptual framework, but this definition is a bit different. So, according to the conceptual framework, equity is the residual interest in the assets of the entity after deducting all of its liabilities. See, so there's no formal explanation of equity according to that definition. It's more of a derivative of the definition of assets and liabilities. So in other words, what is equity? Equity is just assets minus liabilities. Essentially, it's what's left for the owners of the business from the assets once all the liabilities have paid off. So for instance, a businessman has a whole bunch of assets, he sells them all for $1 million cash, pays back $600,000 in liabilities, and he has got $400,000 remaining. $400,000 is the equity. And that little situation is what's played out when you calculate equity. And another way to explain it is that equity is the net worth of the business. So we've got some example equity accounts. So remember, in each of these sections, there are specific accounts and their respective balances. And these everyday equity accounts kind of depend on the complexity of the business. And that, however complex the business is, leads to the variety of equity accounts listed. So for instance, we've got share capital or owner's equity, current or retained earnings. There could be a variety of reserves. There may be preferred stock or even treasury stock. Okay, so let's just review what we've covered. The balance sheet is like a photo. It's a point in time of the financial position of an organization. It lists assets, followed by liabilities, and ends with equity. And assets minus liabilities equals equity. Or if you rearrange that equation, assets equals liabilities plus equity. And that final equation, assets equals liabilities plus equity, is the very, very famous accounting equation. That's it. Thanks for your time. That is a quick guide to the balance sheet. I hope you enjoyed the video, and I hope you can give me a thumbs up for the video. Thanks, guys.